Welcome to Armanino's webinar, Stock Plan Tax Issues for Companies and Individuals. I'm Kathy Hawkins, and I'll be your moderator for the session today. Let's take a few minutes to look at some housekeeping details in using your webinar plane. Please expand it by clicking on the orange arrow if you would like to send us some questions. We would really appreciate hearing from you and would like to address those questions as time permits at the end of the webinar. Additionally, please modify your audio settings so that you get the best sound quality possible. Check telephone if appropriate, or mic and speakers if appropriate. And finally, let's take a look at what it takes to qualify for California CE if you are interested. You must use a personal computer, sorry, no PDAs, and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions, and complete the evaluation survey at the end of the webinar. All right, now let's take a look at who our presenters are today. Scott Borgia, who is a CPA and tax partner in our San Jose office, is joining us. Scott has many years of experience in the corporate tax world, including several years with the Big Four and a considerable number of years here with us at Armanino. We also have Scott Schimberg joining us, who's a CPA and director here at our Armanino office in San Ramon. Scott has more than 20 years of financial, executive operations and consulting experience in both public and private companies, and has held a variety of positions within those firms. Finally, we have Scott Schwartz joining us, who's a manager here at Armanino and our San Francisco office. Scott has worked in the legal and financial industries world for several years and provided financial consulting services to public and private companies as well as entrepreneurs. He's very involved in our equity management solutions practice. All right, so we have the three Scotts on board with us today. Let's take a look at what our learning objectives are. Today we're going to take a look at how to recognize different individual and corporate tax rules for a variety of grants, including ISO, non-qualified, and restricted stock. We're going to review the impact stock auctions have on APIC, deferred taxes, and income tax rates. And we're going to go through some of the tax considerations for preparing to go public and share with you some practices. Here's just a quick look at our agenda to give you a sense of what we're going to cover. You can see we've got four primary areas that we're taking a look at, starting with individual taxes, then corporate taxes, income tax accounting, and IPO considerations. So with that as a foundation, let's start by taking a look at our first polling question. While that is launching on your screen, just a reminder, you want to participate in at least 75% of the polling questions. And the first question is, what type of equity awards do you grant? So this is really just a survey question, trying to get a little bit of information from you so that we can get some perspective. So you've got lots of options there. Thank you so much for getting those votes in. I see them coming. We're going to give you just another moment to get those votes in. Even if you're not participating for CE, we'd really appreciate hearing from you. So please take a moment and give us your perspective. All right, we're going to go ahead and close the polls here in 5, 4, 3, 2, 1. Thank you. All right, I'm going to turn it over to one of the Scotts to comment on the group.
This is Scott Schimberg, and it's really no surprise in terms of the ISOs and NSOs as being the most most likely granted. What we are seeing a trend in, though, is around the performance awards, and that's starting to increase, particularly as companies are starting to go towards a public offering or in the public sector of having pay for performance type concepts. So for kind of companies in that ramp-up mode and trying to get into that area, it is typically in that ISO, NSO area, and then we get into the performance areas.
Yeah, and I mean, I think we're seeing different reasons why, why there's that movement to performance. There's ways to manage expense, as you're ramping up for IPO. There's also just different ways to incentivize people granting salespeople awards and the like. So, but we have seen I agree, we have seen a slight trend in that.
All right, so we'll get a little refresher going on around stock options, and particularly around into the individuals and provide some guidance in that area. And you'll notice when we start talking about these different types of the ISOs and the non-quals, that those types of grants will have an impact on the corporate accounting as well, in terms of some of the calculations of when you could take a tax deduction from that. So it is important to have a good understanding of how these work. And so basically on the ISO, it's very advantageous to the individuals, meaning that there's no tax at the granting or vesting, and that you're only subject to AMT upon exercising, with a certain qualifications of it not being a disqualifying disposition. But if you meet all the requirements, you're basically deferring your taxes, and it can get pushed into a lower tax rate of having capital gains. On the non-quals, it's really delaying the tax until you exercise, and then it just becomes part of your ordinary income tax at the point of exercising, on the spread between your exercise price and the amount that you've taken in as the gain. And then any gain over and above that upon when you actually dispose of the stock would come out as a capital gains. And then similar with the RSAs and RSUs, we'll see those come on, and you could get taxed on the at the vesting point, which is a little bit different than the ISO and non-quals. And there's some ways to avoid that taxing with an 83B, and we'll talk about that a little bit later on down the road. But those are kind of three different buckets in terms of how it impacts the individuals, and different ways that